LA is one of the largest and dynamic markets in the country, if not the world. I mean, the economy of LA County is about 750 billion the last time I checked. If it were a standalone country, it'd be the 19th largest in the world. And it's one of the most populous with 10 million people. You know, it's not going anywhere. And that's what attracts people here is the size and the dynamism of the economy. The rental housing stock here was built out mostly after World War II. There's very little developable land left. And the typical apartment building is what I described. It's a low density, two-story walk-up with a courtyard or a pool. Vast majority of it was built before the 1970s. Almost 90% of it is 50 units or less. What is unique about this market is that because of the smaller asset size that is the typical property profile of a rental apartment building in Los Angeles, it's really hard for institutional players like Paladin to amass a portfolio of scale that would attract significant amount of institutional capital. If the average building size is 30 units here and the average building size is 300 units in Dallas, you have to buy 10 times as many buildings here as you do in Dallas in order to amass the same portfolio. So that's what actually creates the opportunity for us, is because we're one of a handful of institutional caliber firms that are focused on the Southern California market. Most of the ownership here are smaller, what I call mom and pop investors. They're typically a family, kids who have inherited a property that their parents bought. It's been in the family for decades. They've paid off the mortgage, and the kids have, achieved a step up in basis after the parents pass away. And they're either running them like ATM machines, but they don't want to put a dime of investment into these properties. What they want to do is keep unit turnover, vacancy to an absolute minimum, because every time a unit vacates, you have to replace the carpets and sometimes the cabinets and put, upwards of $10,000 into a unit turnover. So they want to keep rents low so nobody moves out. They don't want to put a dime into the building unless they absolutely have to repair that roof, or they absolutely have to fix that leaky faucet. And so what do you end up with? You end up with a lot of tired looking, fatigued properties, a ton of deferred maintenance, and where market rents are up here and current rents are typically 30% below that. And that's where the opportunity is created for Paladin, because we're, unlike most other multifamily apartment markets across the US, where the ownership of assets is mostly institutional. And if it's institutionally owned, it's being run, it's being institutionally managed the way that we manage properties. So every property has RUBS in place. Deferred maintenance is addressed. Amenities have to be refreshed every 5 years. Not the case here in the mom and pop dominated market of Los Angeles. And our thesis for what we do here in a nutshell is to focus on these smaller, older, tired, poorly managed buildings with rents that are 20 to 30% below market. We invest anywhere from $20,000 to $50,000 per unit in exterior and interior upgrades to modernize the look of these buildings. And we apply professional management to optimize operations and increase cash flow. RUBS is one of the first things that we put in place, among many things that we put in place. And then we seek to harvest value, either through a sale or a refinancing, after renovations are complete, that's usually within 3 to 5 years. So, while there are thousands of firms like Paladin executing value-added apartment investment strategies nationwide. There are very few here in Los Angeles, and that's what we love about it, because it sets us apart as a buyer compared to everybody else in this market, except for just a handful of institutions that are focused on these smaller asset strategies like we are. We've had a number of our institutional relationships approach us about doing something programmatically together, because they see our track record, both in Latin America and in LA, of scaling up small asset strategies like what we're doing in Los Angeles. We acquired over the last 12 months, 80 million of properties, 7 assets. And, so they see it. They see our ability to scale up and do this. More importantly, once we buy it, increase cash flow and add value. What we're trying to figure out is, do we want them? Having been on the institutional side of the desk for 30 some odd years, there's pros and cons. And I think that if I were to describe the perfect investor for our platform, it's more of a family office. It's an individual who is a national real estate investor. Maybe they've invested in some institutional funds like Blackstone, and they've invested with some of the national multifamily players. But if they look at their portfolios, they'll see a hole in the workforce housing, the rental apartment business in Los Angeles, because most institutions can't fill that hole.